I'm going to talk about realized volatility today, which I'm sure many of you have sort of heard and seen about before. But I think it's important, and I want to do that sort of for the first bit of my lecture here, sort of put things into a little bit of a historical context in terms of think about sort of how and where we got to where we are today. So I'm going to spend sort of the first maybe 20 or so minutes of my talk today in terms of doing that. And then we're going to go on in this first talk about some current kind of research themes in realized volatility, which is going to be very much in the spirit of many of the papers that are going to be appearing on the program over the next 2 days in the conference. And I guess I should sort of apologize in advance to many of you in the audience that I don't cite in my transparencies here, but I probably ought to cite, and you just let me know and I'll try to rectify that in the future. So that's what I'm going to talk about here before lunch today, realized volatility, and as I said, sort of starting out by putting things in a little bit of historical perspective. Then after lunch, Torben is going to talk about volatilities that we can get from options prices, implied volatilities in particular. And he's going to spend his lecture sort of solely talking about that, and then we're going to finish off later in the afternoon talking about relationships between implied and realized volatilities, which is going to be very much sort of current research for the both of us. And I think there's some very intriguing results to be sort of gathered from think about how implied and realized volatilities relate to one another, and we're going to try to kind of highlight that as we go along. So here's what I'm going to do today in the morning here. As I said, first a little bit of historical perspective, volatility clustering, what it's all about. I know that's going to be pretty boring to probably most of you, but at least for those of you that might not have sort of seen or heard about this before, I'll give you a chance to sort of catch up and so we all are kind of on the same page. So I want to do that, talk about volatility clustering, what that's all about. I'll talk about some of these sort of classical ways, Arch-Gartz type models of dealing with that, and then that's going to get us to this realized volatility concept that I'm going to highlight, and then, as I said, sort of various current themes that I want to talk about. So volatility clustering, what's that all about? Well, it's been known for a long time. Mandelbrot is often attributed as one of the first to sort of observe that. I don't know if he really is, but it's been known for a long time that the changes in financial market prices come in clusters, in the sense that when you have a large price in an absolute sense, it's more likely that the price tomorrow is also going to be large in an absolute sense. So it's not to say you can predict the prices, but you can predict the magnitude of the price changes. So the way you see that here is that if you look at these pictures, this is an old picture of the S&P 500 back then. It's pretty depressing to look at. 2004, it was close to 1,200 back then. Okay, and down here, the corresponding daily, I lost my mouse here, the daily log returns. And what you can see is that there's this clear sort of tendency for volatility to cluster in time. Here in the mid-90s, there really wasn't a whole lot going on. Markets were very calm. And then here, sort of during the tech bubble, there's a lot more volatility. If you looked at NASDAQ, you'd see even more volatility during that time period. Okay? Of course, we all know, as of late, there's been really sort of crazy volatility going on in financial markets. Here's again just a more recent picture of the S&P daily returns, and here you can see this is up until the end of 2008. Here you can see sort of the last 3 months of 2008, and these are clearly much, much more volatile. Okay? A manifestation of that, which is one of the things that the Torben is going to get to talk about, is that we can infer measures of volatility, measures of price variation from derivatives prices. In particular, it's very convenient to do that from options prices. And a measure of that that's used quite a bit these days is called the VIX index, which is the market's expectations, in an appropriately kind of risk-neutralized sense, the market's expectation of what the volatility of this series up here is 1 month forward. And Torben is going to explain all that to us. If you look at that, this is what that looks like. And you can see down here, during the sort of late 2008, there's a sharp increase in volatility. Okay? And in fact, if you look sort of over a particular week in October of 2008 here, in fact, you saw the VIX hitting an intraday high of close to 90, which is, at least by sort of historical standards over this period, pretty much unheard of. Okay? So we've seen very, very high volatility as of late, and you all kind of probably know that. Okay. Now this is US data, this is the VIX, this is for the S&P 500 US aggregate market. You see very similar things. If you look at other markets, in particular I put up a picture of the VDAX for the German market over sort of this I think it's 9 months period, or no, it's roughly two-year period here. And you can see on top I have the VIX from before for the US market, on the bottom I have the DAX, and it really kind of the commonalities in those two series is rather striking. So when there's high volatility in the US, there's high volatility in Germany, or vice versa. I'm not saying anything about the causality here, but there clearly is a strong coherence between the two. Okay? Now, this is not a new phenomenon, this volatility clustering. This has been going on forever. So just to sort of show that, I have here a picture of, these are UK interest rate from 1729 to 1957. Okay? And you see that this picture, for all practical purposes, look very much like the daily return series for the S&P 500 I showed you before. These are monthly interest rates for the UK. But the key thing is here that there are periods when just not a lot of stuff is happening. Like here in the mid-1800s, things were very calm. Okay? In the early sort of 1800, late 1700, there were a lot of volatility. In the 30s, there were a lot of volatility. So these kind of volatility bursts we've seen as of late is not necessarily that sort of abnormal. If you look at them from a longer historical perspective, they are abnormal if you only look back 20 years. Okay? But volatility clustering has been around forever. Okay? So that is kind of the empirical phenomenon that's at the heart of a lot of this research that we're talking about here. Now, why as financial economists should we care about volatility clustering? I could spend many, many lectures talking about that. I'm not going to do that. I'm just going to give you sort of a few very, very simple kind of illustrations in which volatility clustering come in kind of as being of first order importance. Okay? So these are the ones, these are the few things I want to kind of highlight here. Okay? Rather than talk about them here, let me just jump to them. Okay? So in particular, suppose you want to, as a very simple example, suppose you want to forecast the sign of a random variable, the sign of the return, or suppose you want to do market timing. You're interested in the issue of whether the return on the market over the next period is going to be positive or negative. Okay? Suppose that you have two estimates of what the return distribution over the next period, let's just say a day, might look like, or let's say a year. Okay? One looks like this, the more dispersed one, the other one, the more peaked one, that look like that. Now these two distributions, the way I've drawn them here, they have the same mean. So your expectation of what the return is going to be the same. So from that perspective, these two distributions are the same. They have the same mean, they have the same median. But on the other hand, if you're interested in the question, what's the probability of getting a negative return, it's clear that the high volatility distribution has a much bigger probability of going negative than do the more peak distribution, which only sort of is represented by this little triangle down there. Okay? So the probability of getting a negative return is very much related to notions of volatility, notions of dispersions in those distributions. Of course, this is also what you care about when you care about credit risk and think about bankruptcies and the like, which are exactly having to do with the issues of sort of liabilities exceeding the assets in place. Okay? And that's exactly has to do with forecasting things going negative. Okay? So volatility, as far as sort of credit risk and credit modeling is concerned, is really at center stage. Or should be. It isn't always, but it should be in my view. Okay? Another example is that, as probably many of you, if not most of you know, banks, according to the Basel Accords, both 1 and 2, are now required to report what's called the value at risk. There's various sort of criteria that define the value at risk. To be reported 1 day ahead, 10 day ahead, to be reported at the 1% level, the 5% level, or whatever. But in essence, what the value at risk amounts to, it amounts to the quantile in the return distribution at a particular horizon. So what I've done here is I've plotted, these are actually simulated data, but I plotted simulated data that kind of look like the data, the real data we looked at before. Okay? And I plotted along with that the 1% critical value in that distribution if you used a rolling 250-day way of calculating that, which is sort of what people sometimes do in the financial service industry. They simply say, look, let's look at the historical returns over the last year, slide that through my sample, use that to calculate sort of a value at risk. If you do that, you'll get the value at risk by that sort of very, very slow-moving, kind of solid bottom line there. Now, it's clear that that line, on average, is going to be correct. But it's also clear from the picture that sometimes that line is way too conservative, and sometimes that line kind of really misses the point in terms of how much value at risk there really is. Instead, I ought to think about sort of adapting my value at risk to truly reflect the volatility, the price variation that exists that is predictable. Okay, so that's just one more example of that. And of course, people know that, and people are now starting to do that. Another example, as I said, sort of very quickly, if you think about sort of standard asset pricing type arguments, maybe sort of the simplest asset pricing model that most of you are familiar with, would be like the CAPM model. In the CAPM model, you have that the expected return is proportional to the non-diversifiable risk of the asset, where the non-diversifiable risk, according to the CAPM, is measured by its beta, or its covariance with the aggregate market portfolio, scaled by the variance of the market portfolio. Now, the standard CAPM model takes beta to be constant. It takes the variance and the covariances to be constant. Now, people have subsequently, of course, realized that's probably not a good assumption in lieu of the pictures we've shown. It might be more reasonable to think about beta as actually a time-varying sort of quantity. Now, of course, it could be that the covariance and the variance just magically happen to vary in such a way that the beta, in fact, is constant. But that doesn't need to be the case. And in fact, there's been lots of research that have shown that you can do better by thinking about models with time-varying betas. Okay? Of course, you can do that in other asset pricing contexts. You can think about sort of multi-factor models where you factor loadings on the different sort of non-diversifiable risks that are also time-varying. Option pricing is maybe sort of the first and sort of foremost example of where volatility really matters. I don't want to spend a lot of time on that because Torben is really going to sort of teach us a lot about sort of how that all comes into play. But just kind of intuitively, think about sort of valuing a put option. Suppose you look at a put option with a strike price of, say, 20. Okay? What that in effect amounts to is to look in kind of the predictive distribution of the asset for which that option is written. Look at the area under that sort of strike price of 20, take that area and discount that to the present. Now, that area is going to be intimately related to the width of that distribution, goes without saying. Okay? And that's really kind of what option pricing is about, and that's why option pricing is so informative about the width of the distributions, about the volatility. Okay? So, what have we learned so far? Well, we've learned volatility clusters in time. We've known that for a long time, going back to Mandelbrot, if not before that, as I said. Okay? We've known that volatility is central to a lot of issues we care about in financial economics. Okay, I just highlighted sort of a few here, but pretty much any kind of issue you care to look at in asset pricing finance, there's a risk, there's a return, and we've got to think about that trade-off, and volatility sort of comes into play in the way we think about that. Now, those two sort of things, those two observations together suggest that if volatility cluster in time, if it is so important to financial economics, I could probably make better financial decisions if we could come up with ways of actually taking that volatility clustering to heart and predict what the volatility might be in the future based upon what it is today. Of course, to do that, I need a statistical model. Okay, and that's where all of these sort of arts, GARTS, stochastic volatility models that I want to talk very briefly about comes in. So the ARTS model, which Rob Engel got the Nobel Prize for 5 years ago, is a discrete time model that just exactly that. Now, it's a very, very simple and intuitive idea, and I guess sort of most great ideas, when you get right to the heart of it, really is sort of very simple and intuitive. So when you kind of talk to people about this and then sort of say, look, this guy got the Nobel Prize for this, some people say, look, why would we get a Nobel Prize for doing something like that? I mean, that's pretty trivial to do. But sort of the whole conceptualization that you can do that, I think is what sort of really is the key, sort of the genius insight here. So the insight is volatility clusters in time. We need a model to predict that. How the heck can we do that? So what Rob Engel did was he said, look, let's think about that. Let's come up with an explicit model for how we actually do that. How can we, given current information, we are today at time t-1, how can I come up with a model that allows me to use that information in terms of coming up with better predictions of what the volatility is tomorrow, rather than just use some kind of rolling sample historical average of the volatility. Okay. So the model that Rob Engel proposed in his original work that probably many of you have seen was this ARTS model. In particular, he worked with what's called an ARTS Q model. Okay. So if you look what I've written up there, what I have is that the volatility tomorrow is this kind of distributed lag of past squared surprises. So if in particular I think about my sample being of size t minus 1, so q being like t minus 1, and I put all of the alphas equal to 1 over t minus 1, and I put omega equal to 0, this would just say that the variance here is the sample variance. I take my past squared residuals and I sum them up and I divide with how many of them I have, and I get my sample variance. So the insight here is to say, look, we can probably do better than that by assigning higher weight to the more recent return innovations, because the volatility clustering suggests that they're more informative about what's going to happen tomorrow than the ones that happened 17 days ago. Okay? So that's kind of the whole key insight. Do that and find ways of actually letting the data tell you what are the best alphas in terms of doing that. Now, you can't just do sort of the weighted average of the epsilons, because that leads to some sort of statistical problems in terms of looking at this not just as a filter, but as a data generating process, as a formal statistical model. You need formally an intercept here, omega, that's non-zero. Okay. So that's the odds model that Rob Engel proposed. Now, when you take that to the data, what you find is that the data likes long lags here. The data says there's a lot of persistence in volatility. Which is a little bit cumbersome, going out and estimating a lot of sort of alphas up here in these kind of non-linear models. So instead what you can do is you can do very much sort of what's akin to going from an AR1 model to going to an ARMA 1-1 model, or from an AR model more generally to an ARMA model. You can include lag conditional variances on the right-hand side. And that's really all that this kind of GOTS type structure is about. So it says that the volatility tomorrow is what the volatility was today, updated with whatever sort of happened today in the market. Okay? So this is kind of like the simplest plain vanilla GOTS 1-1 model, which oftentimes does a good job of characterizing the volatility we see in daily data. Now, there are lots of other GOTS models out there. Here's a list of some of these, and then there's many more. I recently wrote tried to at least sort of summarize all of these, actually, I didn't count them, but I mean, as I said, there are many more than these. So there's been lots and lots of work sort of done on this. Yeah. Let me show you this picture here. I know some of you have seen this before, but I always like this picture. This is a picture that I saw when I was in Munich a few years ago. Okay, so this is like the subway mag in Munich, and I was looking at this thing here, and one of the things I noticed is that the station up here is called Garching Forschungszentrum, which, if you sort of translate the German, would mean something like sort of research center for guards. So I thought that was kind of pretty cool subway map to have there. I was a little sort of disconcerted by the fact that this was the end station, but I don't know, then maybe again. So anyway, there's been a lot of work done on all these sort of odds-GOTS models over the years. Now, odds-GOTS models are discrete time models. They're models that sort of purport to describe what happens to the volatility of discretely sampled returns, the return over a day, the return over a month, whatever it might be. A lot of the arguments in asset pricing finance, and in derivatives pricing in particular, are based on arbitrage or continuous hedging type argument, which, I guess I sort of almost said that by the way I said that, are much more naturally thought about in continuous time. And it's sometimes awkward to think about taking these odds-GOTS discrete time model and adapting them to sort of continuous time setting. So what that suggests is that we might want to think about sort of come up with similar models, but models that are formulated instead of discrete time, continuous time, so have this kind of fictitious notion of there always being a price at each and every instant in time. Okay, of course, that's what the Black-Scholes model is based on. It's based, in essence, on this continuous time random walk that says that at each and every instant in time, there's a price, and this is the evolution of that price as given by that continuous time random walk model. Now, of course, the Black-Scholes model, and again, I'm sure Tom's going to come back to some of that, assumes that the volatility is constant, which is totally counter to all of the stuff I've been kind of trying to highlight so far. So we need, if we're going to do realistic continuous time models, just like realistic discrete time models, we need sigma to be time varying. And just as sort of there's been a lot of sort of odds-GOTS type models that have done that, there's been a lot of sort of work that have tried to come up with good continuous time continuous time volatility models. Now, the first generation of these kind of models took the volatility to be basically a deterministic function of the price. So in particular, a model that has received a lot of attention in the in the asset pricing literature, oftentimes referred to as the Cox-Ingersoll-Ross model, takes the volatility to be proportional to the square root of the price, which is sort of a special example, but it's also sometimes called the constant elasticity or variance type model. Okay. These kind of models, these models with sort of, in effect, deterministic volatility, are flat out rejected in the data. Okay, people still use them and they can be sort of useful in some situations, but there's no questions that if you actually seriously take any model of this sort here to the data, you're going to reject it. It's just not the way the world works. You need a separate stochastic volatility model to describe the evolution that we see in the volatility. And just like there's been lots and lots of different sort of scarce models out there, I showed you this long list before, there's been lots of different sort of continuous time models that people have come up with. I've listed sort of a few here, but there are many, many other ones out there. In particular, one of the things that people have worked, and there's been lots and lots of work in this literature, have found is that you probably actually are better off by parameterizing the model in the form of multiple volatility factors. So you can think about sort of the aggregate volatility you actually sort of, you don't see, but the instantaneous volatility as really kind of being made up of two separate components. One that's sort of longer lived and one that has a much sort of faster mean reversion to it. You might in fact meet 3 in some situations. Okay. Now, these continuous time models are very convenient because they link in much more natural and elegantly with the finance theory that we have for valuing options and the like. But they're also much more cumbersome and difficult to estimate. And that comes from the fact that the volatility in these models are inherently latent, at least in these stochastic volatility models. One consequence of that is that you can't write down the transition density for the returns you actually, discrete time returns that invariably are going to be discrete, that you get to see. You cannot write that down in closed form in general, which makes inference much more tedious. So this is where all of this kind of realized volatility come in. Okay? So what's the realized volatility about and how does that all link back to all of these other kind of things we talked about? Well, the realized volatility also, in some sense, takes its beginning in one of these continuous time stochastic volatility models. Now, this is an arbitrary model, though. I've made no assumptions about the way in which this stochastic volatility process evolves over time, or for all practical purposes, no assumption. There are a few sort of underlying sort of regularity type condition assumptions. Okay. But suppose that this was the way the world behaved, which is the way we oftentimes like to sort of pretend the world behaved when we do asset pricing. Okay. Suppose this was the way the world behaved, and somebody now came and asked you the question, given the world behaves like this, what's the volatility in this world from time t to time t plus 1? Okay? Well, this should be your answer to that question. The answer to that question is that the volatility from time t to time t plus 1 in this world, the right way of thinking about what the volatility is that it's this so-called integrated volatility or integrated variation. Okay? There are many different ways you can think about sort of justifying that or arguing why that is the right way of thinking about what the volatility is, but the way I oftentimes kind of like to think about it anyway is, suppose that somebody actually told you what this latent volatility process was. So somebody told you, God, whatever, who knows. Somebody told you what this sample path realization of the volatility was from time t to t plus 1, which is not going to happen. You're not going to do that, but by whatever, you got that. Given that information, what is the variance, or what is your estimate of the variance of the returns from time t to t plus 1? Again, this is the answer. So it's in that sense, at least what I kind of like intuitively to think about this, that if you actually knew what the true sample path realization was, conditional on knowing that, then this is what the variance is. Now, of course, there's earlier precedents of this quantity in the finance literature. In particular, there's an influential paper by Hall and White in Journal of Finance many years ago in which they thought about doing option pricing in situations like this with time-varying stochastic volatility. And they came up with sort of a Black-Scholes type model in which you would plug in this estimator in essence in the place of the volatility in the Black-Scholes model under certain assumptions. Okay. Now this is all good and fine, you might say. This is still involving that latent volatility process that I said was kind of at the crux of the problem. That was the thing that we couldn't get a handle on. That was the thing that was latent. So why is this going to be any better? How can I sort of, what is this kind of like, instead of just having to estimate sigma. Why is it any different having to estimate the integral? Well, it turns out it is very, very different, because in fact the integral of sigma I can estimate very, very accurately. And in fact I can estimate it very accurately without a model by using these so-called realized volatilities. So the realized volatility, for now let's just talk about a day. The realized volatility over a day, day t to t plus 1, is simply defined by the squared return over that particular day. Okay, so you take the returns over that day and you square them and you sum them up. Now I say that you take the return over the day, square them, sum them up. How many returns you have over the day, of course, is going to depend upon how frequently you sample. Okay? So you could just have one return over the day. You could just have the daily return. You could take that, you could square that, sum that up, and that would be the realized volatility in my notation here, involving a delta of 1, just one squared return. That's a lousy estimate, as it turns out. I'm going to be formal about that in a second. Instead, the whole idea behind the realized volatility concepts is what you want to do is you want to take high frequency data. You want to take, say, 5-minute returns over the day, square them, sum them up, and get an estimate of the realized volatility. Because there's a very powerful theory that holds very, very generally that says that if you do that in the limit as you sample finer and finer, and if the world is in fact one of these continuous time diffusions that I showed you before, then this realized volatility for infinitely finely sampled squared returns is going to give you a consistent estimator of that integrated volatility, which is the true measure of the volatility. Now when you first look at this is really no different from what people have been doing for many, many years in finance. There's many papers, old papers in finance, where people have gone out and sought to estimate volatility over months by taking the daily squared returns within the months, summing them up, calling that an estimate of the volatility over the months. People still do that, and that's a sensible thing to do. Okay? But what's really sort of crucial here from a formal theoretical perspective is that for that argument to formally make sense, it has to be the case that the sampling frequency becomes finer and finer, which is why high frequency data are so crucial and what gives the power to all of these so-called realized volatility measures. Let me show you just kind of the power of that in this little picture here. So what I did here was I simulated one of these continuous time processes. Which process I simulated doesn't really matter for this. This is what the integrated volatility over a day in a realistically simulated continuous time diffusion model looked like. So that's the true volatility on a daily basis. This is what you would get as an estimate of that if you use daily squared returns. Now that's on average going to be right on, but it's a damn noisy estimate of that. Okay? If on the other hand you use returns 3 times a day, 24 times a day, so hourly returns in a 24-hour market, or 5-minute returns in a 24-hour market, you'll get this realized volatility measure, which for all practical purposes look like it's kind of right on, at least when you eyeball these two pictures here. Okay? So this kind of nicely illustrates this power of this fill-in asymptotics, this finer and finer sampling frequencies as a way of getting good estimates of the volatility we really care about. Another sort of intuitive way that I like to think about this is provided by this kind of couple of days here, this actual data. So these are actual price data at a 5-minute sort of frequency for the S&P 500 back in 2002. Okay. Now these are very different days. These are 3 sort of subsequent days, but they're very different days as far as the returns are concerned. The first day is a negative return day. There's a big, huge, almost 8% return on the second day, and then pretty much a flat day on the second day. If you took the corresponding daily returns, squared them, those days would have very, very different volatilities. The first day at an annualized level would have an annualized volatility of 43%, 125%, and pretty much flat day, 6% volatility. Okay? Now what's interesting is that even though these, if you just had daily data, these days would look very, very different. In fact, as far as the true volatility is concerned, these days are really very similar. If you take the 5-minute returns within each and every one of these days, they all pretty much have volatilities close to 55%. Okay? And that's the true volatility. That's the true price variation for those days. Okay? Now just intuitive, if you think about the flat day, if you sort of just take the opening price and the closing price, that's going to look like pretty much a zero return, but it misses the whole point that there's all these fluctuations happening within the day, which is what the realized volatility measure is able to get at. It's just another example, another illustration of the same thing. Here's over this historical period, 1982 to 2008. This is the realized volatility based upon just using daily squared returns. Extremely noisy. Here's the same thing using 5-minute returns. Much, much more sort of easier to understand and comprehend evolution in the volatility. Okay, so this is I think, a very nice theory, and it sort of works because instead of estimating the volatility at each and every point in time, we say, look, let's not do that. Let's estimate the volatility over non-trivial time intervals. In particular, let's estimate the volatility over a day or longer. And by estimating things over a day, another thing that also happens is that you avoid another complication that exists in high-frequency data that any of you that have worked with high-frequency data are well aware of, which has to do with these very, very strong intraday patterns in the volatilities. So if you look at volatility over the day, it's typically much higher at the open, much higher at the close, and then there's sort of a lull in the middle of the day on average. Okay? That's completely sidestepped in these realized volatility measures. Okay? From a more formal perspective, what sort of goes on relative to methods of trying to actually estimate the instantaneous volatility, which would, in essence, require sort of a double fill-in asymptotics, where you get finer and finer sampled returns over smaller and smaller time intervals. Okay? Here, you don't need that. You only need a single sort of asymptotic. I could be more specific about that, but let's not kind of go there. And then I guess another thing that is really nice is that this, again, everything I said up until now about the realized volatility is completely model-free. I said nothing about what the model for sigma might be or might not be. It holds for any kind of model you care to write down pretty much. Before I move on and talk about sort of uses of these realized volatility measures and get on to talk about some of these, as I said, sort of current themes of research in that area, I want to put it into a little bit of historical perspective because, well, I kind of like doing that, and I think it's kind of important, again, to sort of understand where this comes from. So this dates back to a paper that Torben and I wrote, I guess it's more than 10 years ago now, okay, in which we were sort of, to say it might, we were kind of annoyed by a lot of papers that appeared in the finance literature that claimed that all of these arts, GARTs, and so forth volatility models really didn't do a good job of forecasting the volatility. Okay? Where we just thought we're plain wrong. And we tried to sort of rectify that. So let me try and sort of explain how we did that and then how that sort of what it has to do with the realized volatility. So a lot of these papers that I said that were sort of appearing in the finance literature that were saying that volatility models really weren't any good were based on regressions of this sort up here. Which in macroeconomics are oftentimes called Minter-Sarnowitz style regressions. So what people do in macroeconomics is they ask the question, is a particular macroeconomic model, does that provide a good forecast of, say, GDP growth? So you take the forecast from the model, okay, you regress the actually subsequently realized GDP growth on the forecast from your model, and if your model is any good, if you regress the actual realization of the forecast from the model, you should find a coefficient of 1 there and a coefficient of 0 there. And you can kind of think about the R square from that regression as a measure of how good a model you really have. So the papers I mentioned before in finance were doing exactly that in terms of asking the question, are these volatility models good at forecasting the volatility? So the way they went about doing that was they took the daily squared returns and they forecasted, and they regressed that on a forecast from any one of these different sort of arts-GARTs models. And when they did that, they found typically very, very low R squares, and people went on to write papers and speculate about the fact that all these arts-GARTs models were no good. The problem, of course, with that is that the daily squared returns is a very noisy measure, as we just talked about, for what the true volatility is over the day. And in fact, if you, on the left-hand side, instead of putting the daily squared returns, put the integrated volatility, or an estimate of that, the realized volatility, you get a very, very different sort of qualitative conclusion. Just to show you that here, this is in a theoretical setting. I simulated again a GARTS 1.1 model. This is what the 1 day ahead forecast looked like. This is what the true volatility looks like 1 day ahead. This is what the daily squared return looked like. This thing here does a lousy job forecasting that. You have an R-square of 5%, does a good job at forecasting that. You have an R-square of 50%. Okay. So that's kind of the whole thing, that if you just use measures like that, daily squared returns, you're kind of drowning in noise. It's just all measurement error pretty much, and you can't say much. Now this goes through in data as well. Here's a picture from that paper in which we sort of have the forecast. I don't know if you can see that, but there's a forecast from a model there, the very same forecast there from a GARTS 1.1 model. Then there's a lot of sort of daily squared returns there, which this model does a very poor job at forecasting, but it does a great job at forecasting the daily realized volatility. Okay. So this is actually how sort of Torben and I sort of first got into this, and I think, I don't know, I like to sort of take credit for the fact that I think this is the way kind of this literature really started with this kind of paper in 1988, and people then sort of subsequently realized, well, if we can actually use these high frequency data both to measure the realized volatilities more accurately and think about it in this kind of forecast evaluation context, why not go sort of one step further and actually take these realized volatility measures for whatever they're worth and start looking at them and potentially build models directly for the realized volatilities. So that's been, as Nicholas was saying, sort of a very flourishing literature that has sort of developed around those ideas. Now, one of the things you find that when you start looking at these realized volatilities is that there are a number of sort of quite remarkable sort of similarities in the distributional characteristics across different assets or asset classes. For instance, one of the things you oftentimes find is that not oftentimes, almost always find, is that the unconditional distribution of the realized volatility appears to be close to being log normal. Probably it isn't exactly log normal, but it's a very, very good approximation. Another thing you find is that there's a lot of persistence in the realized volatility. In fact, probably so much persistent as to be best described by a long memory or fractionally integrated type process. Another thing you find is that if you take the returns and standardize it by its realized volatility, that's approximately normal, that standardization. Okay? So all of those observations means that you can now take and you can build models directly for the realized volatilities. Instead of having to resort to either the ARTS-GARTS type model or these much more cumbersome to estimate and analyze continuous time stochastic volatility models, we can build models directly for the realized volatility. We can forecast the volatility we care about using these models. Okay? And there's been lots of work that have done that. We have a paper, I think Nicholas already mentioned this paper in Econometrica a few years back, where we did that and found that these kind of models really did remarkably well. Very simple style, autoregressive type models for the log of the realized volatility does a very good job. And that's not the best model, and there's been lots and lots of work. People have tried to refine these kind of ideas, and there are many papers in the program over the next couple of days in the conference involving different attempts at that. But to a first order approximation, doing these simple kind of AR type structures for the realized volatility gets you like 95% of the way there. So just as you can improve this model by adding all sorts of bells and whistles, the same way you can improve sort of a standard sort of GARTS 1.1 model by adding all of these other kind of additions to that, and people have done, I think this is really kind of the first order approximation as far as sort of getting the use of these kind of volatility measures. Now another thing that again, there's been a lot of research sort of that have picked up on that, has to do with this observation that said that if you take the returns and you standardize it by its realized volatility, that appears to be approximately normal. Okay? One kind of, I think, cute implication of that vis-a-vis some old work, a very famous old work by Peter Clark on what he called the mixed-up distributions hypothesis, is that if you look at the implication of that for what the distribution of the return should look like, by taking the return distribution, decomposing that as the return distribution conditional on the realized volatility times the marginal distribution of the realized volatility. From what I just said, the first distribution is approximately normal, standardized by the realized volatility. The second distribution is approximately log normal. So taking that together, it suggests that the return distribution should be a log normal mixture, which was exactly the kind of distribution that Peter Clark proposed in his paper many years ago without making any of those kind of decompositions, so those arguments. But it comes through kind of very nicely here, and for good theoretical reasons that I may talk a little bit about later on too, that this is in fact what you should expect once you make use of these realized volatility concepts. Now this is just the unconditional return distribution. You could take that one step further and look at the conditional return distribution, and by using predictive models for the realized volatilities, you can get better sort of predictive return distributions. Okay? And again, it seems to work sort of very well in sample, and you can sort of look through some of that. Okay, so this is kind of, I think, kind of the big ideas, if you will, kind of in realized volatility from a practical perspective. There's a lot of sort of fancy theory underlying all of this stuff that I did not talk about here. But I think from a practical perspective, these are kind of like the important ideas and where sort of the literature were maybe 4 or 5 years ago. And there's still sort of important work going on along the lines that what I talked about. But for the last, I guess, sort of half hour, 40 minutes or whatever we got left here, let me talk instead about some current themes that are sort of hot in that area that people are currently working on. As I said, this is going to tie in with a lot of the things that we're going to see in the conference over the next couple of days. So one theme, market microstructure, quote unquote noise. And I put noise in quotation mark here because, well, sort of finance people, market microstructure people don't like to call this noise. Probably better to call it market microstructure effects or something like that. But it seems to have sort of gotten a name of market microstructure noise in the literature. So anyway, so let me explain what that's about. It's about the fact that the price I wrote down when I sort of motivated my realized volatility, the price process I wrote down, was a continuous time diffusion of this sort here. And I put a star on that because that really in practice is a fictitious. Okay? It's a fictitious in the sense that I never really see prices that evolves like that. If I actually look at the price I get to see, they don't look like that. There's no question that prices, actual prices, do not come from a model that look like that. Actual prices live on discrete time intervals. Okay? We also only have observations at discrete time intervals. So this whole fictitious is about being able to observe the price in continuous time is nothing but that. It's a fictitious. Okay? So what that effectively means is that the prices I get to see in practice and the price I get to use for all of my inference and all of my modeling, I should rather think about as being possibly prices coming from a model like that, but think about those as really kind of being latent and then contaminated or influenced by some additional quote-unquote noise term having to do with this price discreteness, bid-ask spreads and the like. Okay. Now that noise term, that bid-ask spread, that discreteness, is going to be there no matter how finely I sample my prices. That's never going to go away. Okay. On the other hand, the variation, at least in this model up here without any jumps, the variation over arbitrarily small fine intervals of the true latent price is going to go to zero. What that means is that in the limit, as delta goes to zero, which remember again was kind of the theory underlying my realized variation measures, this idea of sampling finer and finer, going from hourly to half hour to 5 minutes and so forth, that whole theory really breaks down. Because what's going to happen in the limit here is that this noise term is going to sort of dominate. And as some people have sort of said, that sort of if you're really doing sort of the realized volatility, where you take delta to go to sort of 1 second, you're in effect estimating noise. Now that's kind of baloney because nobody would do that in their right mind and sort of actually use 1 second returns, and nobody has done that. Because people know that you can't do this because of this effect here. That you have to be sort of cautious about not sampling too frequently. Okay? So in some of our earlier work, we sort of used a device that we called a volatility signature plot. But think about, well, how finely can you sample to sort of avoid these market microstructure effects? Let me talk about that because I think it's a useful device to sort of illustrate more generally some of the complications that come in. So what's this volatility signals plot about? So what you do is you'll calculate your realized volatility for each and every day in the sample, t equal 1 to cap t. And you'll calculate for each and every day in the sample for different sampling frequencies. So for day 1, you have a realized volatility based upon 1-minute returns, you have a realized volatility based upon 5-minute returns, 10-minute returns, and so forth. Okay, and you have that throughout the whole sample. Then what you do is you take the sample average of the realized volatilities constructed using 1-minute returns, the realized volatility constructed using 5-minute returns, and so forth. And you plot those sample averages as a function of the sampling frequency. Now, if the market microstructure noise doesn't matter, those realized volatilities should in effect estimate the unconditional sample variance over the full sample. Okay? You can get a good estimate of the unconditional variance over the full sample just by using daily squared returns. And daily squared returns is, for all practical purposes, not going to be influenced by these market microstructure effects. Okay? So what that means is that if you now plot all of these sample averages as a function of the sampling frequency, what you're going to find is that as you sample more and more frequently, okay, the market microstructure effects is going to start to show up, and you're going to get biased estimate of what the true variance really is, which is what you would get if you just average daily squared returns over the two samples. So you can use that as kind of a simple guide or simple device for thinking about, or at least starting to think about, what might be a reasonable sampling frequency to use. Here's a plot of that. This is sort of the medium average volatility signature plot for the blue line here for the realized volatilities for the 30 Dow Jones stock over this period. And these are sampling frequencies in seconds. And what we find is that sort of a sampling frequency of like 300 seconds or 5 minutes. It's kind of roughly when things have stabilized. You can be much more fancy about that. You can put confidence intervals on that, and you can sort of put formal statistical tests on that and so forth. But it kind of illustrates the point that if you sample too finely, you start getting biased estimates. But at some point those biases go away, and that is a good way of thinking about sort of what might be a reasonable frequency to use. So as I said, this whole issue about market microstructure effects or market microstructure noise has been one of the sort of very active issues in this research, and people have sort of come up with ways of, instead of just eyeballing pictures like this and say 5 minutes is good enough, of course you can do that much more formally. You can think about sort of formally finding optimal choices for what's the right sampling frequencies, and here's kind of a list of references to that. And again, apologies to people in the audience that maybe should be up there that isn't up there. There's been lots and lots of other sort of work that have taken place on that. Okay. Another kind of a thing along those same lines is that one of the implications, if we flip back here to my price, the price I actually observe is this true fictitious price plus this market microstructure noise. If this noise term was an IID process, the implication of that is that the price I actually get to observe would be an MA1 process. Okay? This means that I could think about sort of parametrically adjusting for the serial dependence in that and come up with unbiased estimates of the realized volatility. In fact, there's a paper that appeared many, many years ago before any of this kind of realized volatility really kind of hit off by this guy Stu. It appeared in JBS, where he was sort of arguably the first to do that. Now, he didn't make a lot of the sort of same connections that have subsequently been established, but he actually had an estimator based upon high-frequency data of the realized volatility, where he did make that sort of MA type 1 adjustment. And he got an unbiased but not consistent estimator of the realized volatility out of that. You can take that same idea sort of one step further, and instead of just adjusting for MA1 type dependencies, you can adjust for any sort of dependencies using all sorts of sort of fancy kernel type smoothing things. And there's a recent paper in Econometrica by Bandov Nielsen, Hansen, Lunda, and Shepard, where they go through a lot of the details sort of involved in doing that. Another thing is that I said maybe 5 minutes is the right way of sampling. But you can sample at a 5-minute frequency in many different ways. You could take the first return of the day and then go 5 minutes into the day, or you could sort of step 1 minute into the day and then go another 5 minutes into the day, or start with a return that starts 2 minutes into the day and so forth. There are a lot of different sort of 5-minute returns. They're sort of like be overlapping returns, but there are a lot of different ways of doing that. You can get more accurate estimators if you take all of these different sort of 5-minute based estimators and somehow average those. And I think that's a reasonable thing to do, and I think most people sort of probably have started doing something like that nowadays. Now, another thing is that if you make certain assumptions about the form of the noise, this UT term, you can formally derive the rate at which the bias or the inconsistency in the realized volatility measure behave as you sample more and more frequently. You can use that insight by then using sort of estimators based upon sampling at 2 different scales. So you could calculate the realized volatility using 1 minute and 5 minutes. And by knowing how the bias behaves as a function of the sampling frequency, you can in effect knock out that bias. This is very much similar to like sort of jackknife type estimators that people have used for a long time in time series econometrics. You can do that using 2 scales, you can use that looking sort of multiple scales. Okay. So these, I think, were kind of the first kind of a market microstructure, kind of robust ways of doing it. There are lots and lots of other ways of thinking about that. Rowell, who's here someplace, I can't see him, whatever, has argued that sampling in business time is probably a better way of going. Okay. People used range-based estimators. Torben at the conference is going to talk about a paper where he argues that there exists this duality between volatility and times between trades. And you can use that to come up with a duration-based estimator for the realized volatility that arguably is more robust to market microstructure noise. And there are lots and other sort of ways. Now, one thing, pretty much all of these papers up until sort of the last one is that they're all kind of statistical tags. They're all statistical approaches, more or less, at trying to sort of mitigate the influence of this UT term. One of the things that I think is kind of really intriguing is to possibly try to bring in sort of more theory, potentially market microstructure theory, for coming up with even better estimators that utilize the fact that UT is not just necessarily a noise. There's actually an underlying theory that sort of might help us in terms of understanding what UT sort of looks like. Now there's a conflict there because once you start doing that, these measures are not model free anymore, and you lose some of the appeal from that perspective. So I think that's still sort of very much out there. Now, I talked so far only about univariate realized volatility measures. Okay, you of course can also talk about multivariate realized volatility measures. I'm going to talk a little bit more about that in just a second. But as far as kind of these market microstructure effects are concerned, that raises a whole other kind of set of issues. Because once you're talking about estimating things like realized covariances, and you have multiple assets, not only do you have to deal with kind of the discreteness and the bid-ask bounds or whatever, then there are also issues having to do with the fact that the prices of the different assets are not necessarily recorded at the same point in time, that the assets don't trade at the same point in time. There are going to be non-synchronicity issues across the different assets, and there are lots of different ways of dealing with that, and I think that's still sort of an area where sort of the best estimator is to be determined. There are other variation measures. A lot of these things that I mentioned have sort of focused on estimating realized volatilities, but there are other variation type measures that you might want to estimate in sort of noise robust fashions. Okay, so that was kind of one theme, and as I said again, as you saw these sort of long list of references, this is a very active area. Okay. Another arguably sort of equally active area has to do with what are called jumps. Okay. Now, the model I wrote down and the way I sort of talked so far was a model in which the prices evolved as a continuous time diffusion, consisting just of the first 2 terms on the right-hand side there. But in many situations, it's more realistic to think about asset prices as containing discrete price jumps. That is to say, if you were to sort of think about drawing the price evolution over time, you can't draw the price path without kind of lifting the pen from the paper. All of a sudden, there's a jump. Okay. Now, one way to think about that is through this kind of jump process. I've written it here, where QT is a counting process that will count the number of jumps up until time t, and kappa t here is the size of a jump if a jump in fact did occur at time t. Now, there are lots and lots of work that people have done. I listed a few papers there, but there are many, many more out there that says that this is really probably a better way of thinking about asset prices, that they contain jumps or discontinuities. There's nothing wrong with any of the theory I talked about so far. All of the theory I talked about so far in principle sort of accommodates that. Okay, I've got to be more specific about that. Here's just another more fancy way of sort of writing jump process. I'll not go into that. As I said, there's nothing wrong with any of the theory I talked about as far as if the price process did in fact contain jumps. In that situation, the realized volatility or the realized variation given by the sum of the squared high frequency returns as a sample finer and finer in this model would go to our sort of old friend, the integrated volatility, plus the squared jumps. But this, in fact, this thing here, the integrated volatility and the squared jumps, is again what really you ought to think about as the true volatility over the t to t plus 1 time interval over that day. Okay? So what that means is that everything I said so far is perfectly valid. It's perfectly okay, and there's nothing, as I said again, wrong with that. And we could sort of pretend as if that term was not there, just go ahead and sort of treat it just like the other term. However, what this observation suggests anyway is that maybe we can do even better than what we've done up until now, because these are really sort of two distinct components. There's the integrated volatility having to do with the smooth price evolutions, and then there's the squared jumps having to do with these discontinuities in the prices. That's what's make up the total volatility. Maybe I can do better by separating those two components. Okay? Maybe I can do better, just intuitively, say in a forecasting sense. I'm going to show you examples of that in a second, but intuitively, at least I would think, and it turns out that seems to be the case, that there's a lot of persistence in the integrated volatility, but there's not a lot of persistence in the variation coming from the jumps. So when a jump happens, it just kind of happens, and then it kind of like doesn't necessarily sort of has a lot of its own dynamic persistencies to it. What that suggests is that some of these models we talked about before for forecasting the realized volatility, I could potentially do better by separating those two components and building separate forecasting models for that part and that part, if I could separate the two. So how would I separate the two? Well, the first to sort of suggest ways of doing that, and I guess Neil Shepard is not here, but I could say it anyway. I think this is not necessarily sort of the preferred way anymore, but at least the first way of doing that was this so-called bipower variation, which is a very sort of ingenious way of coming about a way of doing that. So what the bipower variation does is it does the following. It says, look, let's, instead of taking the squared returns and adding those up, let's take the absolute return in this time interval, multiply that by the absolute return in the 5-minute time interval immediately preceding that. If jumps, in fact, are rare events, which is one of the sort of assumptions here, that the latter term are sort of things that happen not all the time. It can be more formal about that, but let's not do that. What that means is that if there's a jump in this time interval, there's not going to be one in that time interval also, or at least not in the limit. So the cross product with an asymptotic distribution of that, and there's been lots of work sort of done on that, and this is what that looks like. Okay. So anyway, so this allows us sort of a non-parametric way of thinking about separating out jumps from the continuous sample pass variation. Okay? It also allows us to think about, in sort of a systematic fashion, issues such as what is it that causes these significant or the big price moves, okay? Which of course are sort of intimately related to sort of fundamental issues having to do with like price discovery, market efficiency, and the like. Okay. Now there's a huge literature, Torben, myself, and lots of other people have written in that area that suggests that many of the sort of the big moves we see in market or in asset prices are oftentimes associated with macroeconomic announcements. At least if we look at sort of broadly defined market indices like the S&P 500 or interest rates and the like. Okay. So what we've done in some of our work is we say, look, let's now take these now formal statistical ways of identifying jumps, and let's think about, do these sort of statistically identified jumps in fact map in to macroeconomic announcements? And it turns out that oftentimes they do, although not always. So what I've shown you here is from this paper here, I've shown you sort of over this, in this paper, this happens to be the largest in a sort of an absolute sense, significance t-statistic for testing for jumps happens on this particular day. Okay? Now if you take that particular day and plot the 5-minute returns within that day, standardized or log 5 returns, actually it's just log prices, starting at 0, normalized, this is what the evolution of the log prices at a 5-minute frequency looks like, and you can see there clearly is a jump on that day at that particular time. Okay? Now you can go back and you can look at what happened on that day, and in fact it is the case that on that day there was a very important macroeconomic announcements. Okay? On the other hand, if you look at a day like that, which if you just look at daily data, you might think of as sort of a jump day. Because this day is a day in which the market rose by almost 8%. And with daily data, that's going to look like a jump day. But in fact, this is a very sort of smooth day within the day, and the jump statistic for that day is not significant. Okay? So I think this is kind of an interesting idea, and I think that there's lots more that sort of could be done there, and people are actively working on that, trying to use these kind of jump measures or statistics for doing that. Okay? As I said before, as kind of a way of motivating some of this, you could take the realized volatility using these statistical sort of jump measures and break it up into the continuous sample path variation and the variation due to jumps. And my intuition was that I used to kind of motivate some of this, was that this bit here, the jumpy bit, was probably not as predictable as the variation due to the continuous bit. In fact, that turns out to be the case. If you do sort of a simple regression type model in which you take the daily realized volatility, regress that on the daily lagged continuous bit, the lagged continuous bit over the past week, and the lagged continuous bit over the past months. This, by the way, this model structure here of using sort of lagged daily, weekly, and monthly variation measures is oftentimes a good way of getting at what looks like sort of long-run dependencies in volatilities. But here doing that, breaking the variation up into the continuous bit and the jumpy bit, what you find is that the jumpy bit doesn't really contribute much in terms of explaining the variation tomorrow. Now that's probably not entirely true. We can probably refine that and find some contribution. But to a first order effect, again, I think it's true that most of the predictable variation comes from the continuous bit. Okay? There's a table that kind of illustrates that. Let's not go through the details of that. Another thing about jumps that also, let me just kind of highlight this. And I know this fast, there's a lot of things up here, but I want to sort of highlight a lot of the things that are going on, and just to kind of give you a taste of some of these things. Another thing about jumps is that they also have sort of distinct distributional implications for things like the standardized returns. One of the things I said before was that if I looked at the returns standardized by the realized volatility, I got something that looks approximately normal. Suppose that the true world was a diffusion like that. Okay? And if I looked at the distribution of the returns standardized or conditional on the sample path diffusion, this would be what that distribution would be, as I mentioned before. What that means is that if I take the returns, demean it, standardize it by this guy there, the integrated volatility, I should get something that's Gaussian. Now this is, in theory, what I should get if that's the truth. Okay? This pure diffusion model implies that this is what should happen. Okay? Now, of course, I don't get to see the integrated volatility, but I approximate that by the realized volatility, which explains why I see this sort of approximate normality in the data. I see that approximate normality, or that's what I should see theoretically in this model here without any jumps. Now, of course, if there's jumps, that's going to invalidate that assumption. So you could think about also, as far as kind of utilizing that distribution implication that I talked about before, that has been utilized in coming up with predictive distributions, you could think about sort of adjusting for these jumps and take that into consideration. Another complication that comes in along sort of similar lines is that if you look at the returns standardized by the integrated volatility, okay, there's a lot of literature that suggests the existence of sort of asymmetries in the volatility, sometimes called leverage effect. I'm going to talk a little bit more about that later this afternoon. Okay, which basically means that if there are these kind of asymmetries in the relationship between returns and volatilities, then the integrated volatility would be informative about the returns, which means that this thing here, if that's informative about the returns, should not be Gaussian either, even if there's no jumps. Okay? Now I can find ways of also undoing that using what's called the time chains for continuous local martingales. And in this paper, these two papers there, Tobin and I have sort of ways of doing that, and actually come up with jump adjusted returns that when sampled in not calendar time, but sampled in realized volatility time, looked to be Gaussian. Okay, and I think there are lots more that could be sort of done along those lines too. Okay. In particular, I think there are a lot of sort of multivariate extensions along those lines that are sort of particularly intriguing. I said that the Banov-Nielsen-Shepard test, this bipower variation test, was the first test and the first sort of ways of doing these kind of separations non-parametrically. And I think it's a reasonable way of going, but I don't think it's probably the preferred way in the end. There are lots of other tests that people are currently working on, many based upon sort of threshold type ideas, or oftentimes sort of using various power variation type measures. And I think some of these other tests might be the one that kind of survive, but I think the verdict is still kind of out there which of these are really going to be the preferred one in the end. Okay, so jumps, that's another area that I think is ripe for research. Another area sort of ripe for research, and again let me just kind of sprinkle a couple of ideas out there, has to do with sort of multivariate variation measures. Of course, most of the issues, maybe not most, but well, maybe most of the issues we care about in finance are sort of intrinsically multivariate in nature. We care about covariance risk oftentimes, not just variance risk. So we have to estimate covariances, not just variances. Now you can generalize all of these parametric R-scar stochastic volatility models that I started out talking about to multivariate models, and people have been busy doing that. The problem with that, though, is that once you take these R-scar stochastic volatility models and try to generalize them, it becomes very cumbersome, in particular if you want to do it in really big dimensions. That these models are very hard to estimate in dimensions of, say, 100. Okay? They're very hard to estimate by at the same time being sort of empirically realistic and flexible enough. On the other hand, the realized volatility concept generalizes kind of straightforwardly, at least in theory, to a multivariate context. So what you could do is that if you have sort of a multivariate diffusion, you can just define sort of a realized covariance measure by the cross product of the squared return vector, and you get an estimate of the integrated variance covariance matrix. Okay? And there's nothing sort of really fundamentally new to that. Okay? Theoretically. I'm going to get to some of the practical issues in a second. Okay. Anyway, what that means is that now we can start thinking, and we've done some of that, we can start sort of looking at things like realized correlations, for instance. You could take the realized covariance divided by the realized variance for the two asses in question, and you can look at realized correlations. Here's kind of an example what we did in one of our sort of first papers on these realized volatility ideas. These are a sample plot of daily Deutschmark, daily yen realized correlations. And you can see the clear sort of temporal dependencies in those realized correlations that you can pick out. Okay? So you can start think about sort of building models for the realized correlations. Just like you can build models for the realized variances, the realized volatilities, you can now model and forecast realized correlations. One of the things I just mentioned a few minutes ago was that when you took the returns and you standardized it by its realized volatility, you got things that looks approximately normal. You might get even better results if you jump adjust the returns, but let's not do that for now. So here are three density plots. There's a plot of the raw daily dollar Deutschmark return, that's the more peaked one, and then there are two that are practically indistinguishable. One is the daily Deutschmark return, standardized by its corresponding realized volatility. The other one is a reference normal. So this thing here is approximately normal. Okay? But of course, these standardized return distributions are going to be correlated across different assets. So what you might want to do is, instead of just standardizing by the realized volatility, you might want to standardize by the realized variance covariance matrix. Okay? Just to illustrate kind of the power of that, what is shown here is shown a scatter plot of the daily Deutschmark standardized by the realized volatility return against the yen standardized by its realized volatility return. So each and every dot here corresponds to a pair of daily standardized returns. Okay? Marginally, these distributions are Gaussian. So if I integrate it out, I would get marginal Gaussians. But they're clearly correlated. On the other hand, if I standardize by the realized variance-covariance matrix, or the square root of that, I get this scatter plot, which looks pretty much like sort of a scatter plot from an uncorrelated bivariate Gaussian. Okay? So I think there are a lot of kind of intriguing ideas that has yet to be explored along these lines, how we can really do this in potentially sort of even bigger dimensions. What happens if I have jumps in here and I want to adjust for jumps? What about leverage effect and so forth? But again, I think this is kind of like a lot of exciting kind of research ideas potentially sort of building further on these results. Another thing that I started out mentioning was this thing that oftentimes in finance we care about betas, or factor loadings. Okay. Now the classical sort of static CABM model would have your betas be constant. Okay. You could generalize that by thinking about sort of having conditional covariances and conditional variance, and you could have conditional beta models. And you could sort of build Arts-Gartz type models, stochastic volatility models, multivariate models in which these vary over time, and people have done that. In very much the same spirit though, you could also then think about just coming up with realized beta measures over, say, daily or weekly or monthly time intervals. Okay? So let me show you a plot of that. Okay, so these are for there are 25 Dow Jones stocks here. We lost 5 stocks. Normally 30 Dow Jones stocks. I can't remember why we lost 5. Anyway, whatever, in and out of the Dow, yeah, whatever, yeah. So here there are 35 Dow Jones stocks here over this sample period. And what I plotted here is the realized betas that I would get if I use daily returns. Okay, these are quarterly realized betas. In fact, I haven't actually plotted the realized betas. What I plotted is I plotted 95% confidence intervals around the realized betas. Okay? So the realized betas would be sort of somewhere inside these confidence bands. So these are 95% confidence intervals for the realized beta based upon daily returns. Okay? Now if you look at most of those confidence intervals, I mean not most of them, but many of them, you could actually draw a straight line through that without going outside those. Which is just another way of saying that sort of from that perspective, the beta over this period was for all practical purposes constant. Okay. Now look at, sort of fix this picture in your mind, this picture of these sort of the confidence intervals for these quarterly realized betas, and compare to this picture here. Okay. This is the same 25 stocks, and it's the same betas, but the betas are now constructed using, instead of daily returns, 15-minute returns. And it's clear that these are much, much narrower confidence intervals, or put another way, they're much more accurate beta estimates. So just like you can get more accurate sort of daily realized volatility estimate, you can get much more accurate multivariate realized volatility type measures like betas. And of course, having more accurate estimates of what the true risk of the betas really look like are going to allow you to make much more precise and better inference and more informed economic decisions. Okay? We have a paper a few years ago where we sort of did some of that, where we looked at realized betas of some of the farmer friends, size along this axis, book to market along this direction, sorted portfolios, and these are just a plot of the sort of realized betas. And we didn't put confidence interval on them here, but it's clear that there are sort of discernible temporal variations in the betas over this time period. Okay? In the paper, I don't know how much I want to hang my hat on that anymore, but in the paper we make the argument that the realized beta tend to increase in bad times. Bad times here is this one recession period here, especially for high value or high book to market portfolios. So that will be these guys here. Okay? But anyway, the point being that having these more accurate true risk measures, we can and should be able to do better than otherwise. Okay? Another sort of recent thing along those lines is that there are lots and lots of work, I just listed a couple of them, but there are lots of other work that suggest that we have sort of stronger co-movement in kind of extreme market situations. That when markets sort of really go bad, things tend to go bad together. Okay? Now one implication of that, or one way of thinking about that, is that maybe one way of sort of rectifying that within sort of a standard one-factor Cabin model is potentially to think about there could be different kinds of betas. So in the spirit of what we talked about, there could be continuous betas associated with continuous price moves, and then could be betas when sort of when things really go sort of haywire, when you have jumps in the market that sort of load differently on those. So I have this paper with Viktor Todorov where we have sort of ways of estimating these different betas, and we find ways of actually coming up with sort of meaningful different betas, and it seems to make a difference for doing that. Let's not talk about that. So let me wrap up here, sort of almost on time. Multivariate issues. Okay, there are a lot of multivariate issues. Okay, I talked about some. Okay, do multi-factor models. Okay. Modeling, forecasting, realized covariations and so forth, realized covariation, dynamic portfolio choice. Barbara Ostig is here, I think I saw her a little while ago. This is actually a great paper. This is probably sort of one of the first realized volatility papers that really made use of these realized volatility papers in sort of an economic context, where what they did in that paper was they used these realized variations and covariations to come up with better sort of portfolio choice decisions. And I think there's a lot more work that could be done along those lines using some of these new and better measures we talked about. Think about the impacts of jumps and the like. Okay. There's this whole issue that I pretty much kind of sidestepped. There's a lot of papers in the conference, though, not a lot, but there are a few papers in the conference anyway that I saw dealing with sort of market microstructure noise in a multivariate context. How do you estimate realized variation measures in the presence of these noise? And I think there's a lot to be said about that. There's issues of jumps that I didn't talk about, but we talked about jumps in univariate context, but you of course can also think about sort of jumps in a multivariate context, and could be issues of like code jumps. Think about tests for when asset prices jump together, and I think those are kind of really the jumps that you as an investor sort of would be scared about and would sort of worry about, because these are the jumps that you arguably cannot easily kind of diversify your hedge against. And so I think there's a lot of work that sort of could be done in terms of thinking about that. So let me stop the first lecture here. So yeah.
You have discussed a lot of sort of normal approximation, some standardized form. But I think the alternative view is a sort of the rare event formulated in extreme value theory. Mm-hmm. And possibly whether the jump, actually, that you consider jump as a sort of extreme event.
Right.
They can be formed.
I think that's a very good point. And sort of trying to sort of mix these kind of jump type events with extreme value theory and how to learn from that, I think is very interesting. In fact, again, sort of in the interest of self-promotion here, I'm currently working on exactly some of that stuff with this guy, Viktor Todorov, where we use some of these jump measures and we use extreme value theory to learn really about what the tails of the distributions look like. And I think that there's a very interesting kind of interplay between those two things. I didn't talk about any of that extreme value theory too, but it's clear that many of the jumps are going to be the extreme value stuff, and that's going to be speaking to those kind of events, yeah. So, yeah.
Maybe in a way my question is related to this question in a way. What about the scaling properties of volatility? Has there been a close look at that?
There's been some work on that. I mean, as I said, there's a lot of evidence to suggest that volatility is sort of fractionally integrated along memory, okay, and there are scaling implications that come out of that, okay? So that if you look at sort of the sample variances of the variances over sort of longer and longer time intervals, they should scale linearly, and that does seem to be the case. So there are various papers that have demonstrated these kind of nice scaling laws for these realized variation measures that are consistent with notions of long memory also. I think the scaling here comes from the long memory property.
So if you've got a model for, say, days, can you be sure you can interpolate to, say, months, years, or even decades?
It's a good question. I cannot be sure about that. I mean, I wish I could, but that's a good question. I think that's part of what we learn, and that, of course, is where the scaling issues come in. Okay, and I don't think there's been a lot of work done on that. Okay, we're actually trying to take these kind of scaling results and actually really use them and try to demonstrate they work. So again, that's another interesting thing to do. Yeah.
Is possible that the beta coefficients for jumps have an impact on the beta for the continuous model?
I'm not sure I understand exactly what I mean. What our results suggest is that seems reasonable to think about different betas associated with continuous kind of day-to-day price moves and different betas in very sort of dramatic or arguably jump type scenarios. That's what sort of our results is. I'm not sure I understand exactly what your question is. Oh yeah, they could change over time, sure, definitely, yeah. I don't know very much about that yet. I mean, we just haven't explored that, but I think that's an interesting thing to explore, and there could be that the continuous betas change over time as well. That certainly is a possibility, and that I just don't know. I mean, a lot of what I set up here, if it wasn't clear, is still sort of work in progress, just kind of ideas, and for everybody to kind of dive in and work on and help us move forward.
Volatility and the infinite activity.
Yeah, there's recent work. Again, there's this guy Viktor Todorov, and Viktor Todorov, together with a colleague of mine, George Tauken, have done ways, there are other people too, but I know some of their work, where they've done ways to think about sort of differentiating between different activity type processes, and they have sort of a measure of this activity index, and they sort of use that. I don't know the work in sort of all its detail, but you can certainly use some of those realized type variation measures to get at differentiations along those lines, if that's the question. Yeah.
I'm trying to design a large-scale survey for households in India, for the Securities and Exchange Board of India, and I am trying to understand how these notions of volatility can be built into trying to understand attitude towards risk and portfolio choice.
Okay, I think they can. I think part of the way they can is, in particular, if you think about the interplay between some of these variation measures and some of the variation measures that are implicit in asset pricing, because by looking at the interplay between the two, you're going to get measures implicitly of the market's sense of risk aversion or notion of sort of scaredness, if you will, or whatever. We're going to talk more about that, both Torben and myself, sort of in the afternoon, about sort of think about how these things are related to both what happens in, these are all sort of what we would call like the physical, the actual, or the objective distributions, what we talked about so far, okay? These are based upon actual prices for the actual underlying assets, okay? But the thing that Torben is going to talk about are going to be volatilities that are based upon inferred from in particular option prices. And there's a risk premium in there that speaks to exactly the kind of issues you think about. So I think your question might be sort of more pertinent when we sort of get to some of that later on.
Okay, no more questions? Yeah.
It's just a comment.
Yeah, sure.
It was really the question on the scaling properties. It would be great to look up decades, but high frequency data is kind of maybe 2 decades long, or we only have about 20 years, and that's for very few assets. So it's something we tried to explore in an earlier paper way back in '97 or something. But I think it is limited by the fact that we have a relatively short horizon and in some kind of historical context. So I think it's to be explored. I'm optimistic.
Right. I think it is an intriguing idea, though, to use a lot of the insights we get from these high-frequency data and think about adapting those to sort of time periods where we might only have coarser, sort of daily frequency data over a long period. Because probably if the scaling laws really are true, you should be able to use the daily data over the longer samples and stuff like that. So, I mean, I think there's a lot that potentially can be learned by sort of mixing and matching the two. But, I mean, that's work to be done.
Okay, so I think it's time now to close the morning session. Thank you, the speaker, once again.